The increase in investment across Africa is highlighting the need for the development of the continent's capital markets. The establishment of safe and liquid markets will be crucial to the next growth phase on the continent. And this was one of the key themes debated at the recent Trading Africa conference, hosted by Thomson Reuters and Barclays Africa in Cape Town. One of the issues was the role financial institutions have to play in solidifying existing capital markets.
Africa is a frontier market, but that doesn't mean that it's the Wild West. I think we have a lot of talented people that are committed to growing financial markets across the continent. As has been mentioned in this conference a lot, Africa is a very youthful population, so I think the energy and the drive behind doing it is really significant. Yes, the markets are not deep, they're not liquid yet. I mean, it depends where you are in the continent, but even a place like Nigeria, with its really large economy, the financial market is relatively underdeveloped. So we see our role, as a big international financial institution, as actually helping develop the depth, the liquidity, but also, as you correctly mentioned, just the international standards that we all want our markets to operate in. And the reception is very good. We work very well with local clients, local regulators, and the journey is extremely exciting.
I was very naive about Africa when I first got here, and but I was blown away by the opportunity here. And I was blown away by the opportunity for our business in particular. And as I mentioned, in my keynote earlier, our vision really here is to empower Africa's success. So when I travel to places like Uganda or Nigeria or Kenya, and I just excited about the buzz of the opportunity. I mean, obviously, there's scary parts of Africa, and that's what we're all here to talk about as well, is how to do business in these risky environments safely, as well as making a return. From a Thomson Reuters innovation perspective, working with these African economies, African governments, and their unique needs here on the continent, and that's what it's really important, is to have that unique African perspective versus just trying to pop in a London solution or a New York solution and say it's going to work here.
Regulation reform across most major financial centers such as Hong Kong and London has accelerated following the 2008 banking crisis. These changes are affecting the way financiers are approaching funding. Donna Oosterhuizen, Director of Capital Markets at the JSE, said that the reforms have some positive impact on access to capital for new projects across the continent.
I see a tremendous shift occurring, and some of us may feel, well, it's only happening in the big financial centers like the United States, New York, the UK, London, and Frankfurt, Hong Kong, and so forth. But I think it's having a big impact on us in Africa, and very specifically in South Africa. Some of the impact has had a constraining effect. Some of the impact has had a very positive impact. And I think one of the most important things to note is in our markets in Africa, and particularly in South Africa, I think we've been of the opinion, or we've been had the perception that bank lending has been the most important driver of capital markets activity and has been the most important intermediary of capital flows. But surprisingly, if you look in South Africa, the assets of the non-bank institutions, the pension funds, the asset managers, and so forth, are over 8 trillion rand. The assets of the banks are closer to 5 trillion rand. So they're almost twice the size of the assets of the banks. Since the financial crisis, we've seen an increase in regulation, as you point out. We've also seen a constraining evolution in bank lending. Bank lending has actually slowed down, a lot of that due to Basel III regulation, but a lot of that due to the bank strategies of just trying to get back to basics. And so, notwithstanding the reduction in bank lending, there's still a great need for capital formation, for capital intermediation, particularly here in Africa, where we have big infrastructure needs. We have a big need for access to capital by small and medium-sized businesses. We also have a greater awareness of risk and the need for risk mitigation. So I think if you take all that together, the opportunities for exchanges to play a positive role is very important. So whereas there might, one might assume, well, all of these changes that we're talking about have been negative, I think they have resulted in an opportunity for exchanges, an opportunity for financial sector reform across Africa, but also in terms of the relative performance of economies in the world, and some of the events that are impacting other emerging markets have had a beneficial impact to us.
Well, they will, without a doubt. I mean, if we look at Africa, I think the biggest conundrum that we find ourselves in is just how do we access?
Yeah.
So you spoke briefly just about the underlying market. So if we look in South Africa, the OTC market with regards to the capital markets, it's easier to price credits. It's easier to price the listings. It's easier to list them on the exchange. It's easier to trade them because there's a secondary market. However, one of the hindrances is when you go into Africa and you look at capital markets there, without a doubt there's a need to fund. You've got higher interest rates, but it's relative because you're funding at the bank, you're funding going through a bond exchange, etc. is going to be a similar scenario. However, in terms of going forward and growing that market, what is your view around developing the underlying OTC market so that you can take it onto exchange and you can create the derivatives around that and you can create that secondary market, which ultimately, in my opinion, will drive the global appetite, which in South Africa we've seen that drive of foreign flows into our country, which has helped to alleviate some of the pressures around our current account deficit. So just talk us through in terms of not just South Africa, but where do you see the opportunities in Africa, and just some of the risks, but also some of the opportunities.
Yeah, I agree with what you're saying, and I think there is a symbiotic relationship between the OTC market and the exchange market, and I don't see it as a zero-sum game.
Yeah.
That if either you go OTC or you go exchange traded, and the size of the pool is what it is.
Yeah.
I think as the OTC market grows, so will the exchange market, and as the exchange market grows, so will the OTC market.
Yeah.
The OTC markets are very important in some of our jurisdictions in Africa because there's not access to data and information that will allow companies or issuers to comply with issuing regulation. So it's not that they don't want to be transparent, there just aren't mechanisms to distribute the information, to format the information, and so forth.
Hopefully that's where Thomson Reuters can come in.
I think there's a good opportunity for Thomson Reuters. I was going to come to that. I completely agree with you. So I think that there is a need for that, a great need for that. So I think while that happens, and if you look at the evolution of capital markets, there's a lot of discussion about what needs to be done and in what sequence.
Yeah.
I don't think that we've cracked the sequencing issue yet in terms of what should be done first, second, or third, but I do think we know what needs to be done, and I think there's a great awareness that we need robust regulation that will stimulate savings in pools of capital, to allow issuers to raise money and traders to trade. We need regulation that will define what securities markets are, define ownership rules, and so forth, and also that will prepare the infrastructure. It's one thing to buy and sell, it's another thing to be able to clear and settle on time, with minimal risk and at a minimal cost. So I think we know that these things need to be done. But while these things are getting in place, as you say, there's still this need for financing, and that's where the OTC market comes in. The banks play a very important role in terms of risk assessment, in terms of intermediating deposits into loans. But I think that as time goes on, for them to continue to have capacity to do that, they're going to have to find a place to lay off that risk. And also, as companies raise money, there will be a limit to what they can raise through debt. They're going to need to increase their balance sheet footings and equity. So I think the exchanges, and there's going to be a role, to support bank lending and support OTC activity through formal capital raising on the exchanges, through equity boards for small and medium-sized companies, professional boards or specialized qualified investor boards that will allow the OTC players to trade among themselves, have guaranteed settlement, have clearing and margining arrangements that minimize risk. So I really see this as being symbiotic, and I don't see it as a zero-sum game, and I think there's plenty of room for both.
Reforms to regulation are creating new opportunities for funding crucial developmental projects in Africa and making granting funding a safer process. The region is still facing significant risks from multiple directions, and in many instances, the risks start at the very top, with ratings awarded to sovereigns by rating agencies. Matthew Perney discusses the risks in South Africa and across the wider region.
South Africa is on a stable outlook, so the most important thing for the viewers at home to look at is the outlook, and the outlook is stable at the moment. We have brought down the rating twice in a few years, so at the BBB- level it is stable. So it's very unlikely that a rating agency will move a rating from stable straight down. Usually the outlook is a good signifier. So I think a lot of the kind of press that's being used about will we go to junk status for S&P, by the way that's not a rating agency term, that's an investment bank term, you really have to signal for the outlook. And we are seeing some kind of economic bounce, even if a modest one, because of the impact of the Labour from last year, obviously not coming through this year. There is restraint to growth, but on the whole it is looking a slightly better economic picture, although obviously not booming.
And Eskom?
Eskom is a restraint to growth, and will continue to be for a few years. If things get significantly worse, then yes, it is a rating factor. But then the entire infrastructure gaps are a rating factor, not just Eskom. Eskom is more direct. We hear a lot more about Eskom. And obviously we rate Eskom as a different entity anyway. But the infrastructure gap continues to push the problems through, and this large social problems that happen in South Africa.
So if we look at we've looked at a couple of real success stories in Africa over the summit, and one of the things we've spoken about is the collaborative efforts between government, the private sector, and then just talking about regulations and how to make this game work and a win-win scenario for both sides. So if we look at what's happened in South Africa, and with regards to the S&P outlook, what do you think are, not just in terms of the budget that we've recently seen, but are you cognizant of the fact that the language used around a budget can potentially be to allay fears, or are you much more data-driven in terms of actually analysing the underlying macroeconomics?
It's a bit of both. Our criteria is as qualitative as it is quantitative. There is obviously quantitative metrics, and if you look at the South African story, on a purely quant basis, it's gone downhill. Debt to GDP, the economic growth story alone would show a picture where the rand's gone. There's so many market indicators would show South Africa's a weaker credit. But having said that, there are kind of the inherent strengths of South Africa, the strong institutions. Not many people talk about how strong Treasury are, how strong the regulator is
and
here.
The banking system.
And the banking system is very strong. It's a great example. And therefore we do also factor that very strongly into South Africa's rating. And to be quite clear, South Africa's rating wouldn't be where it is today without the strength of those institutions.
So let's move over to Africa now, because one of the things that we've been talking about at the summit is about creating that level playing field. In Africa, we battle for lack of transparency because of the fact that there's not a lot of data, there's not a lot of infrastructure. So measuring those quantitative issues is relatively difficult. However, having people on the ground that understand the underlying economy certainly makes for a better decision. So talk to us about how S&P looks at sovereigns across Africa in terms of trying to rate those.
So there's 18 sovereign ratings in Africa, 2 of which are investment grade, South Africa and Botswana, and Nigeria is the only BB credit. All the other credits are in the single B level, and that would seem to show that from a single B, obviously it's fairly risky, but the spectrum within the BBB is obviously BBB-, BBB and BBB+. There is the way that we go about it, we have very clear and transparent criteria. You're talking earlier about some of the impacts of the crisis. We've been very clear in our changes to criteria to make it sure it's very transparent now, to a point where anyone with a credit background should be able to pick up our criteria, use similar data and come up with a rating within 1 or 2 notches. That was the goal of the criteria. So we've managed to do that across the continent, and you can see that across the African continent there's a number of generalities. Weak GDP per capita, fairly weak institutions, and an infrastructure gap. There are commonalities across the African sovereigns which leads them all to be in the single B category, well, most of them.
Improvements in infrastructure are crucial to rating agencies such as Standard & Poor's for the determination of credit assessments, which in turn lead to more foreign direct investment into the continent. It's time to take a short break now. When we come back, we take a look at the countries bringing business to Africa and the way in which governments can work with them to improve funding mechanisms on capital markets. Stay with us. Welcome back. African capital markets have seen accelerated growth rates and rapid reform over the past 10 years. This alongside heightened interest from foreign investors. One major region with increasing importance to the continent is China. The Asian powerhouse's involvement in Africa is evolving. Chinese investors are increasingly working with governments and focusing on consumer-facing industries as opposed to merely mineral extraction.
I think firstly, the Chinese companies and investors we're talking about now, they are very, very different to those who came to Africa 10, 15 years ago. You're talking about in the early 2000s, those are really state-owned enterprises. So they came to Africa with an agenda for securing raw materials and to feed the manufacturing hub in China. But what we're seeing now is those are new investors. They are private equity fund managers. Those are private investors. They would like also a share of the African story. So we see there's a gradual moving away from mineral extraction and mining to more consumer-based sector. For example, telecommunication, media, hospitality. And so they're looking for cash flow. Okay. So in other words, because
speaking to consumers, not just speaking to raw materials.
I think they understand Africa now is urbanization. It's very quick. You know, the urban area is expanding. So there's also concentration of people and consumer. So the Chinese are looking into partnership to explore this market. At the end of the day, if we look at the mining industry at the moment, it's actually pretty quiet. And then also the commodity prices are not doing any good to the sector.
Sure.
So I think there's a major shift of people looking into other sector. As I mentioned, telecommunication is an example.
So how do you identify the sovereigns that offer those best opportunities? So do you look at hindrances? Are there risks associated to those? Or do you look at Africa as a single continent?
I think Chinese would look at, for example, where is the most conducive place to do business. They look at very much going fast into Africa. For example, in East Africa, in Uganda, Burundi, those are the new hotspots.
But those are Central Africa, so there's a logistical issue, right?
I think they focus on the coastal area because it's easy to do export. It's still very much an import-export country.
Okay, so that's one of the key identifiers.
Yeah. South Africa, they're still coming here because of its conducive financial judiciary system.
Well, you have that infrastructure.
Absolutely.
Yeah.
So, but they're using it as a hub to go into Africa.
But then if you look at the Chinese economy, I mean, there's also been a lot of infrastructure built. So I think the Chinese economy, from my perspective and my understanding, would be that you understand lack of infrastructure and how to create that to enable business to function more effectively. What is the contribution that they're making in Africa, do you feel, that adds to that in terms of the understanding of building a frontier market?
I think Chinese is working very closely with different government to help them with infrastructure. We all know that there are lots of resources in this continent, but the challenge is how to get them to the port. So they are assisting African country, you know, with road, with airport, ports and so forth. And very often, although they can't pay for those infrastructure, so there will be something like, you know, resource in exchange for infrastructure. So at the end of the day, your country still need those infrastructure, but instead of paying by cash, you're paying by mineral and
so raw
resources.
And then talk to me about what your experience has been with regards to the cross-sovereign trade. So when we look at Africa, it is without a doubt something that there's different languages, different currencies, you've got different cultures, etc. Is this something that you find as a hindrance, or do you think that it's something that can be quickly overcome?
I think for Chinese, one of the biggest challenges for Chinese to operate in Africa is still the communication gap and then also the cultural disparities. And having said that, it's not the language or English or French per se, but it's more the way how Chinese communicate and how Africa communicate to Chinese.
And are you talking then about data, or are you talking about creating infrastructure around capabilities for Wi-Fi, creating telecommunications, etc.? Is that specifically what you're gearing yourself around?
I think even before we reach that stage, it's more about on the negotiation table. Sometimes people just don't understand what you're talking about. So there's a lot of misunderstanding. So once we clarify that misunderstanding and what we actually want to achieve, then we can move on to talk about the infrastructure like the Wi-Fi, like the data. And quite funny enough, you know, in the rest of Africa, the speed of internet is much faster than us here in South Africa.
It is.
So in Chinese is funding other African countries are more conducive doing business. The government is more welcoming. They don't have very inflexible labor law, for example, but they still play their active role to create employment.
One way in which governments are creating an enabling and functional lending environment, the Botswana Development Corporation is one African success story in which the careful regulation of capital markets has contributed to the long-term economic growth.
I think there's no doubt Botswana is an amazing success story by African standards. I think a number of key things have driven that success. I think primarily it's been around good financial management of the economy. That without a doubt is probably the starting point for the economy. Diamonds have enriched the government, and as a result the government has not lined its own pockets, not lined the pockets of unscrupulous business people, but has really taken that money and put it to good use in terms of development. Education, health, infrastructure, those are really the big long-term investments which government has used, taking the diamonds, the revenue from diamonds.
That's very refreshing, because I work with quite a lot of people in Scandinavia, and they have this policy where they look for 3 generations ahead of them to ensure that the infrastructure and what they build now facilitates opportunities for their grandchildren effectively, or their grandchildren's children. Yeah. So in Africa it's something that we don't see a lot of, and we talk about corruption, we talk about the fact that we do have money, we've got resources, there's opportunities, but where's that money going, and are we seeing these infrastructure spends that are relative to the market? So you talk about Botswana growing. What is it with regards to lessons that you've learned that potentially the rest of Africa can learn from?
I think that's really great. I mean, I think one of the big lessons is around opening up the economy and creating more market-friendly policies. I think that's been very useful in terms of attracting investment into the country, in terms of enabling the businesses to grow. So I think that's a really big lesson. I think if anybody out there is looking, I think that's a big lesson to learn from Botswana, is how do you open up the economy with very specific programs and policies, starting right with immigration. How do you reform immigration to allow easier work permits and visas, right down the way to how do you give investors access to land, how do you allow investors to be able to trade freely, how do you enable investors to repatriate their funds, because that's important for investors as well. So all of those, that whole program around opening up the economy, market-friendly policies, is a big lesson I think that other African countries can learn from.
Well, it's certainly, for me, somebody that looks at all these market reforms that are coming in from both the United States, the European zone and the UK, the infrastructure in Africa is not that developed. So we don't have archaic tools. We don't have tools. So in terms of building those type of sustainable opportunities to create that investment, because at the end of the day we need to have a level playing field. And in terms of Africa going forward, do you think that there should be more collaboration? If we look at Africa as a big continent, we can't expect it to be one continent. So what do you feel about the West Africa, East Africa, Southern Africa collaborative efforts that speak to that zone within the global economy?
Quite frankly, I think not enough has been done. I think if you look at an aerial view of just take the rail infrastructure of Africa as a continent, you will see that the infrastructure really talks to extracting things out of the continent. I think it's going from small towns, big cities, right to the coast to get stuff out. I think what we need is infrastructure that integrates Africa and allows people to travel more freely, starting with that, allows trade to happen. I mean, at the moment, for many people to travel within Africa, they have to either fly through Johannesburg or even fly through Europe.
And you have to get a visa to go anywhere,
and you have to get a visa to get anywhere. So I think those are sort of infrastructural things we need to get around. More importantly, I think, to manage the cost of infrastructure, there has to be collaboration, because a lot of this infrastructure will cross multiple geographic jurisdictions, and so it's important that when you lay the railway line, you have the buy-in from South Africa, from Mozambique, from Botswana, to allow a seamless flow of trade and for the project to even get off the ground.
Capital markets in Africa are still on a steeply inclining growth curve. However, the discussion and application of solid rules around minimizing risk and increasing efficiency can have a major impact on the continent's GDP going forward. Thank you for watching.